My name is Ayaz Ebrahim. I have been at JPMorgan for 8 years. I have been managing Asian regional portfolios since 1991, investing in the Asian equity markets. I've managed the JPMorgan Asia Growth and Income Investment Trust since 2015 when I joined JPMorgan. I manage the fund with Rob Lloyd, who's another senior regional portfolio manager, and we've been managing it together since 2015. JAGI gives a broad exposure to the Asia equity markets. The equity markets in Asia gives investors returns for the longer-term growth of the Asian economies. We invest in high-quality and premium companies in the Asian region that we believe will compound returns for investors over a multi-year period. The JAGI dividend policy is, at the moment, to pay quarterly a dividend to shareholders amounting to 1% of the NAV. JAGI is very much a bottom-up stock selection investment strategy. In terms of the risk of the portfolio, 80% of the risk is actually through stock selection. We have a very, very strong research platform. We have about 100 investment professionals that cover the Asian region. And these investment professionals really do a lot of research on the companies in Asia, really understanding them very well, and doing very robust analysis for us as portfolio managers to build conviction on the stocks that we are investing in. There is a very strong team approach between the analysts and the portfolio managers to come up with views on companies in the Asian region. In addition to stock selection, we also have a top-down overlay, which means that we can also underweight and overweight countries depending on the attractiveness of those various regions at any given stage of the cycle. So we may overweight certain countries because we think over a shorter term period that country may do better than others, but we may also underweight countries because we think over the shorter term other countries may do better. The growth in Asia continues to be the highest in any part of the world. And this is still being led by big countries such as China, India, and even places like Indonesia. These countries have populations of over 100 million people. GDP growth in these areas are still very high. Indonesia, which we sometimes forget about because China and India are so big, also has a population of over 100 million people. And Indonesia is also growing at a very rapid pace. What does all this growth mean? This growth means that the consumer, your average person in all these countries, their income levels and wealth is growing. And that means growth for goods and services in all areas that you can think of. In terms of delivery of banking services, the demand for consumer goods, the demand for insurance products, the demand for healthcare, and there's a whole host of companies that are listed in this region that benefits from this rising spending power. We build conviction in individual stocks by doing a lot of research on companies. And frankly, there's no substitute for just plain hard work in researching those companies. We have 100 investment professionals covering a lot of companies in the Asian region, and it's not just one person that's looking at one stock. We have at least 4 or 5 people that are looking at one company with building that research knowledge, which is shared then amongst the team. The sharing of this detailed work really builds conviction for any individual portfolio managers. And these views are shared formally through models that are in our systems, but also through regular communication as we discuss things. So in short, it is very, very robust analysis, strong financial modeling, but also continuous communication between team members. So we mitigate macro risk by reviewing our country allocations on a regular basis, and we formally do it quarterly, but it's a dynamic process. If we feel things are changing on a macro basis, we do adjust our country weightings. We can go more overweight or underweight countries, and we take into macro considerations when we do that. In addition to that, by understanding our companies really well from a bottom-up level, We understand what factors could affect companies from a macro basis, and if we see some of these macro circumstances changing, we will adjust our weightings in companies by either reducing their weightings or selling them, or perhaps buying some companies that will benefit from certain macro changes. We believe that the investment trust structure benefits Jaggi investors because by being closed-end, we do not have constant inflow and outflow of cash. What does that mean? It means that us as portfolio managers are managing the portfolio without worrying about how much money may be coming in or how much money is going out. So we manage it in the most efficient way possible as a result. In addition to that, the structure, the investment trust structure, allows us to gear. We do not gear often, but when we have extreme market conditions, when markets become very cheap, and our experience has told us that when markets do become very cheap, there is an opportunity to be had, is that the probability of markets going up over the next 12 to 24 months is high. And that's when we actually gear the portfolio.